Good afternoon, everyone. On behalf of the Insured Retirement Institute, I'm pleased to welcome you all to today's webinar, Making Compliant Rollover Recommendations. I'm Jason Berkowitz, IRA's Chief Legal and Regulatory Affairs Officer. This is the latest installment in our ongoing Standard of Conduct webinar series. We launched the series last February with a session that provided a broad overview of the Standard of Conduct landscape, both here in Washington and across the states. And since then, we've held 6 or 7 additional sessions that have provided deeper dives on key developments as they've occurred. Much work remains to be done, and significant questions continue to hang over our heads about whether and how policymakers might seek to further adjust the regulatory framework. But after more than a decade of public debate, federal and state agencies have seemingly coalesced around a workable best interest standard that is generally consistent across jurisdictions, at least for now. And our members are prepared to undertake the necessary hard work to implement this standard as adoption proliferates across the country, which will require continually updating in policies and procedures, modifying systems, training, and more. Today's webinar is being sponsored by InvestorCOM, and we are grateful for InvestorCOM's partnership in bringing this session to you. In a moment, I will turn the floor to Clara Massari from InvestorCOM, who will be leading us through today's session. But before we get started, let me just cover a few quick housekeeping items. First, the conference lines will be muted throughout today's webinar. If you have a question during the presentation, please use the questions function in the GoToMeeting toolbar. We will attempt to address questions as they come in, and we have also reserved some time at the end of the presentation to cover additional questions. We will try to answer as many questions as possible in our allotted time, but if we have any questions that we can't get to, we will certainly follow up by email. And following today's webinar, you will receive a follow-up email with a link to the recording of the webinar and the slide deck, both of which will also be available on the IRI website at myirionline.org. And with that, I'm happy to turn things over to Clara.
Okay, thank you, Jason, and welcome everyone. I think it's best if I ask our esteemed panelists to introduce themselves. May I begin with you, Carol?
Sure. Hi, I'm Carol McClarnon. I'm a partner in Eversheds Sutherland's Washington office, and I specialize in ERISA and subspecialize in how it applies to financial services companies.
Ed, can I pass the baton to you?
Sure, I'm Ed Wegner. I am a managing director for Oyster Consulting. I provide compliance and risk management consulting to broker-dealers and investment advisors. Before that, I joined Oyster in July of last year. Before that, I was with FINRA. I was with FINRA for 22 years, and I was most recently the Midwest Regional Director for FINRA. And while I was at FINRA, we spent a lot of time looking at rollovers, and it's been very interesting to see how things have evolved since.
Thank you, Ed. And I'll be sort of the MC or moderator for today's session. My name is Clara Massari. I'm the VP of Regulatory Strategy at InvestorCOM. If you haven't heard of InvestorCOM, we're a leading regulatory software provider in the wealth and asset management industry across North America. Our intuitive solutions, like Rollover Analyzer, are award-winning and aim to eliminate compliance risk. Having said that, let's jump into our agenda today and what we intend to cover. We'll first start off with a backgrounder around the developments around the regulatory timeline specific to rollover recommendations. We'll then focus on emerging rollover issues that stem either from the SEC, FINRA, or Department of Labor, and then focus on what firms will need to really dive deep on from a compliance perspective and what to expect next. And as Jason said off the top, we've allotted an extended period of time to address any questions you may have throughout today's session. So please use the chat box or the question inbox to submit any questions throughout today's presentation. Okay, just so we can get things warmed up, maybe Laura, I can ask you to start out with our first poll question. And really, the first poll question, we want to know, how prepared are you to meet the Department of Labor's PTE 2020-02 rollover requirements? Are you and your firm just getting started? Are you almost there, or you're ready to go? curious to know what the results are. Interesting. I'm just going to sort of read out the results in case folks can't see it. 53% of our, I think approximately 180 attendees today have responded. 20% are just getting started. 68% are almost there, and 13% believe that they're already there and ready to go. So this is certainly interesting, given that we took a similar poll back in August of 2020, and at that point in time, 50% of our attendees had suggested that they're just getting started. So certainly an improvement on that front. Thank you for your engagement. Now let's just jump into it. Given what you're seeing on the screen here on the timelines, Carol, maybe I can ask you as an ERISA lawyer and expert, maybe give us the timeline, sort of a background around the specifics to the rollover recommendations, and why is this back on the agenda?
Sure. You know, as you can see from the timeline, the DOL came out with a PTE last year, PTE 2020-02, for conflicted investment advice. And what the kicker was in that was this interpretive language, as they called it. If you're familiar with ERISA's definition of an investment advice fiduciary, it's a 5-part test. And you know, for years and years, a lot of people relied on the regular basis test for rollovers, and they didn't meet the regular basis because it was a one-time thing. And the DOL kind of wrapped into the prohibited transaction exemption this interpretation that in many cases, rollover advice is enough to become a fiduciary, but also enough to engage in a prohibited transaction, because what ERISA provides if you're a fiduciary is that, you know, anytime there's a conflict of interest where you use your own fiduciary authority to cause yourself to get additional comp, that's kind of the basic 406B prohibited transaction, then you have to find an exemption. And so what's going on here with 2020-02 and the temporary enforcement policy and all of this is it's not a rule of ERISA per se, but if you're in a situation where you're a fiduciary and you're giving rollover advice, you want to find an exemption so that you're not have exposure for prohibited transaction violations. And with these deadlines coming up, that's what all the excitement's been about.
Thank you for sharing that, Carol. Now, this term rollover keeps coming up over and over again. Ed, you mentioned that at FINRA in your prior capacity, you had actually examined rollovers. You know, can you just touch on why is there so much regulatory scrutiny around rollovers between state regulators, FINRA, SEC, and now the Department of Labor?
Well, thanks, Param. Yeah, it's rollovers have been a priority for regulators for some time. Like you mentioned, I was at FINRA in 2013 when they issued their regulatory notice 1345, which really spelled out the suitability and supervision requirements for broker-dealers when recommending rollovers. And then the SEC came out with Reg BI, which has specific requirements with respect to rollover recommendation. And as Carol had mentioned, you know, sort of throughout the last decade, the DOL has been grappling with rollovers, most recently with the PTE. And it's not surprising that this is an area that the regulators are focused on. You know, as they've mentioned, and it's clear, retirement savings are probably the biggest financial concern for many savers and investors. And apart from their homes, retirement savings are often an individual's largest investment. And then if you look at the financial institution side, fees from managing retirement assets make up a very significant portion of the revenues for financial services institutions. And studies have shown that rollovers are by far the largest source of contributions for IRAs. And As a result of all of this, regulators are concerned about the incentives that exist for recommending rollovers and the long-term impact that higher fees have on retirement savings. So as a result of all of this, it's been an area of considerable focus and concern for regulators. And things are really starting to take shape now between Reg BI and DOL coming in. And so it'll be interesting to see how things take shape between now and July, when this is supposed to be fully in effect and enforceable.
Thanks, An. Now, Carol, you mentioned something that maybe folks in our audience are wondering about. Can you, Carol, can you explain sort of this notion around the temporary enforcement? What's that all about?
Sure. What this dates back to when the last iteration of the fiduciary rule was overturned and vacated. What happened at the time was the DOL issued a non-enforcement policy that basically said, if you're acting in good faith, we're not going to assert any kind of prohibited transaction based on the last fiduciary rule. And that was pretty much what we had up until kind of July of 2020, when they came out with the new PTE and then kind of tried to backdoor a new fiduciary definition as part of the PTE coming out. And so they extended the temporary enforcement policy through to the Biden administration. Some of us were surprised that it kept going and that the rule actually went into effect, because it was on the agenda for the administration to look at it and maybe change. And so that was set to expire this December. And a lot of people in the industry, a lot of the industry groups went in, and Jason could probably speak to this, to the DOL, and explained how much trouble everybody was having coming up with some resources for the condition of the exemption, where you're required to kind of compare an IRA with the plan expenses and come up with estimates if you don't have the actual plan. And so that's where we ended up with getting to the December 20th December deadline getting extended. And the DOL did not extend the whole exemption, other than to give a few more weeks, but they did extend that particular portion of it, the rollover documentation and disclosure portions of it, until July.
Awesome, thanks for sharing that, Carol. Jason, you've been, as Carol alluded to, you've been engaged with the regulators, including the Department of Labor and the SEC, and given the evolution and scrutiny around rollover recommendations, what are you hearing on the street? What do you believe the regulators are trying to accomplish here?
Well, first, thank you again, Parm, for including me on the panel here and for bringing this session to our members. You know, I think that what we have to remember is that at the start of this all, the objective of the regulators is to protect consumers, and that's an objective, obviously, that I think we all as industry can fully endorse and support. Where we run into trouble is in the details. As they say, the devil is always in the details. And here, as Carol indicated, the department has tried over time in several different instances to move the line between what is fiduciary investment advice and what is non-fiduciary conduct that a financial professional can engage in without triggering fiduciary status and without having to worry about prohibited transaction exemptions and the like. They continue to push the envelope. I think what we saw in the 2020-02 preamble was a significant attempt to reframe that exemption, or that definition rather, in a way that more closely aligns with the changes they contemplated and pursued back in 2016, but in a way that doesn't subject it to notice and comment rulemaking. So I think there's a lot of question as to the validity of the interpretive position that was taken in that preamble. I know some have questioned whether that would actually prove to be enforceable if it did end up in court. So we'll have to wait and see if and when that becomes an issue that gets any challenges in litigation. But looking ahead, I think what we'll continue to see is efforts to make sure that investors are getting the type of advice that they should reasonably expect from their financial professionals. And what we are working right now to try to help the department understand is that there may not need to be a whole lot more rulemaking to accomplish that objective. The SEC, as we heard, has already adopted Reg BI, which covers securities-based recommendations. The National Association of Insurance Commissioners has updated its annuity suitability regulation to impose a comparable best interest standard on insurance producers. And so that the warrant of options that could be presented really are already subject to an effective and meaningful best interest standard. And so we just need to kind of work with the department to make sure that they find an appropriate path forward here to clean up some things. Maybe there's some reasons to make some adjustments, but I think for the most part, PTE 2020-02 should be left alone. There's some other exemptions we may get into later on that also should be left alone that likely won't. And so yeah, there's quite a bit of attention on this, and we also continue to have the SEC paying attention here. We actually had a chance at IRA just a couple of weeks ago to have a conversation with Chair Gensler and his senior team, and they really reiterated, that what they've been saying on the Hill, which is, this is not the rule that we would have adopted, but it is the rule that we have, and we're going to do our best to make sure that it lives up to its name. And so they're pursuing through examinations and ultimately potentially through enforcement actions, efforts to try to make sure that it actually is accomplishing its objectives.
Living up to its name. That's a big feat. Ed, maybe I can transition over to you. And speaking of the SEC's Reg BI and living up to its name, can we spend a few minutes just looking at the SEC's expectations around rollovers as it pertains to Reg BI? What's required, what's not from a regulatory perspective, and considering examinations, Ed, what do you think the SEC is going to focus on?
Very well, so Reg BI became effective in June of 2020, and like Jason had mentioned, that it already does cover for broker-dealer securities-based recommendations, and defines the standard of care that broker-dealers have to abide by when recommending securities transactions and investment strategies to retail customers. And they do specifically speak to rollover recommendations. And for rollovers, in addition to just the general requirements that they have under Reg BI, it requires a specific assessment of the rollover transaction and specifically comparing alternatives, comparing things like fees and expenses, the levels of service that are available between the employer plan, the IRA that's being recommended, and in some cases, another employer plan, looking at different available investment options, ability to take penalty-free withdrawals, the impact on required minimum distributions, protection from creditors. So it lays out in Reg BI a number of things that individuals and firms need to consider, broker-dealers need to consider when making a recommendation for a rollover. Unlike the PT, and we'll get into more detail with respect to rollover recommendations, Reg BI doesn't specifically require documentation and disclosure regarding the basis for the recommendation, although in most cases, where you'd be making a recommendation for a rollover under Reg BI, you would also be doing so subject to the PTE. So in that case, you would have to have the specific requirements for documentation and disclosure with respect to rollover recommendations. So, but it'll be interesting to see as the commission continues to do their examinations what their findings are and how that shapes what they do going forward. NASA just recently issued a report that outlined some of their findings and some reviews that they were doing, and SEC Commissioner Crenshaw was at a conference last week with the NSCP, and this came up, and she said that she's very interested, and the commissioner is very interested in taking a look at the results that other regulators are having when they're out conducting an exam, looking at that in the context of the exams that they're conducting, and really coming up with an understanding of whether the regulation is meeting the goals that they had set out. So I think it'll be interesting to see what they find. There'll be more to come.
Thanks, Ed. That's a lot to digest from a Reg BI perspective. Now, speaking of overlap and sort of shifting over to the PTE requirements, Carol, maybe I can ask you this, as Ed touched on, the SEC didn't explicitly require this documentation, retrospective review, best interest disclosure to the individual investor. Would you be able to touch on sort of why is that on the radar now? How is that going to be sort of looked at from a Department of Labor's perspective?
Sure. I think what my understanding is the big change initially with what DOL was requiring and what the SEC had required was this comparison, this direct comparison, and particularly the point that if you could not get the actual information from the participants, you had to come up with some sort of estimate that you're going to use to compare. So I think that was the start of the DOL going down this path. In the proposal, when the PTE was proposed, it discussed having to, what you have to look at and, how you have to document it. And there was a comment to the proposal where someone said, well, you really ought to be giving this to the participant as well, not just kind of keeping it inside. You really need to disclose. And so that was bopped on to the final PTE without having gone through kind of the comment period. So, although DOL is becoming more of a disclosure type of regulator, I'm not sure that a lot of thought was put into exactly how this was going to play out. And so that's where people are struggling a little bit with like how much detail needs to go into this. I mean, those sorts of questions, because there really wasn't a lot of background given to us about what the participant disclosure should look like.
Understood. Hey, maybe we can kind of take that and maybe Jason, I can sort of ask you, what are you hearing from a disclosure, from a documentation perspective, from making compliant rollover recommendations from your members? Has these requirements really heightened the degree of compliance for your member firms?
Yeah, I mean, I think, the feedback that we're getting is really very consistent with the results of the poll that we did at the top of the hour here. We're hearing very, very significant feedback from most of our broker-dealer members that they're generally expecting to be pretty well prepared to comply with the rollover pieces of the exemptions requirements sometime towards the early part of next year. Where there's a little bit of concern and confusion, and I think some work that needs to be done, is in the timing of the delivery of the requirements. We're hearing that particularly in cases where you're not dealing with electronic business, where you have a customer on a phone call with an advisor and they maybe have a conversation that leads to a decision to pursue an annuity, technically they're supposed to be providing the disclosures at or before the time the recommendation is made. But in that circumstance where the conversation is happening in real time on the phone, there's not an efficient way to necessarily get that done. And so that's something that I think a lot of firms are going to be using the additional time that the department has provided to try to resolve for.
Now, what's the general confusion around sort of specifically the disclosure? From what I understand, the regulations are saying, hey, the best interest analysis around the rollover, that needs to be disclosed to the end investor. At the same time, there's sort of understandings around disclosing that you are a fiduciary. Does that all get wrapped together in one when what's being delivered to the client? What does that tend to look like?
Yeah, I mean, I think what I'm hearing is that the fiduciary acknowledgement is typically going to be sent probably in a separate. In many cases, it'll probably be sent separately ahead of time, and that way that piece is taken care of. There may be circumstances where it makes more sense to loop it all in together. I think in the case of existing relationships, a lot of firms are going to be putting those fiduciary acknowledgement disclosures into their regular disclosure and reporting documents that they send to clients on a regular basis already. So that was part of the reason for the extra few weeks on the front end of the temporary enforcement policy extension, was to allow for that to be done at the end of the year with year-end mailings, as opposed to 11 days before the end of the year as a separate mailing. So that was a logistical adjustment that they recognized was needed. But in terms of the content of those disclosures, I think that that's something that firms are getting more comfortable with the idea of. I think that there's still some question about, what do we do exactly if the data that we need about the existing plan isn't available? Can we use estimates? Can we use other proxies for that data? And I think that the intent from the department is to allow that after a good faith effort has been made to obtain the actual data on the existing plan. But I think that the information that they've shared publicly in terms of guidance on that hasn't quite persuaded everyone that they can be comfortable relying on it yet.
Well, and then the question comes down to, like, what are they expecting in terms of those estimates when they say that it's to be a reasonable estimate? What are they going to be looking for? And there hasn't been a lot of guidance there. And I've heard a lot of different things from a lot of different people in terms of what they're planning to, do in that regard. And so it'll be interesting to see if hopefully some additional guidance comes out, or if it doesn't, what the industry does to meet those requirements. And then as, examinations to the extent the DOL examines for this, or actions come out that maybe further define what it is that they're looking for. But that's been a big question for people.
Yeah, and I think, the other thing that's really interesting here is that, I think that there are some firms that are going to take a very, very conservative approach. I've heard from a couple of people who are contemplating using a baseline of 0 for the existing plan, to say that it has, regardless of what the actual is, let's assume that it's got 0 cost. And so we're comparing to something that is, this is an entirely new expense for the investor. And if they can get comfortable that it's still a best interest recommendation with that overly conservative estimate, then they should be very, very well positioned to defend their recommendations. But that's also, as I said, extremely conservative and may actually significantly impair the ability to actually make some of these recommendations that would be in the best interest of the client, if the actual data were available.
Excellent. This is really, really good conversation. Folks in our audience, please engage and let us know if you have any questions. We are tracking those questions, and we're going to address them at the end of today's session, sort of on the 45-minute mark approximately. And maybe as we transition to the next segment here, I can ask for you all to participate in our next poll. These are always sort of interesting just to see what the results end up being. How do you plan to meet the rollover requirements? Update your process and procedures manual, deploy technology to meet the requirements, or maybe a bit of both. A bit of Jeopardy music in the background before we close the polls and see the results.
You have to read the results in the form of a question.
So we've got 47%, 48% voted, and 25% of folks are going to be updating their P&Ps, which is great. 4% are going to be deploying technology to meet the requirements, and 71% are planning to do both. So there's a lot of work ahead of us in the next coming months. And maybe we can talk a little bit about sort of what's to come. Carol, maybe I can ask you to sort of maybe potentially simplify the set of requirements. PTE 2020-02 sounds like a bit of a mouthful. It's been misquoted by many. What does it mean from an implications perspective to financial professionals? Let's start there, and I have some follow-up questions.
Okay. As I mentioned before, PTE 2020-02, it's not like an ERISA rule itself. So it's not something that you have to comply with in order to be in compliant with ERISA. What it does is the PTE stands for Prohibited Transaction Exemption. And so if you've decided you're a fiduciary and you've decided that you have a potential prohibited transaction, your next step is to go and find an exemption to comply with. And so 2020-02 is an exemption. And if you comply with all of the requirements of 2020-02, you don't have to worry about the prohibited transaction and the rollover. Now, there are other prohibited transaction exemptions that could be available in certain situations. For example, PTE 8424 for the sale of annuity insurance contracts. So the idea is you have to find one PTE, and 2020-02 is designed to be the main one that will cover most rollover advice.
Gotcha. And now there's a January 31st deadline for the PTE 2020-02, and then the June 30th deadline for disclosure and documentation. Can you just touch on that for our audience today? Why is there sort of that 6-month gap between the two, and how we got there?
Sure. The 6-month gap came as a result of Jason and other industry leaders going up to the DOL and saying, we just can't comply with this. We're having trouble figuring out how to do this. And so, we would all have, it would have been great if they had extended the whole thing, but they extended the part that they were convinced the industry really did need extra time on. What's happening now is the temporary enforcement policy is extended until February 1st, essentially. And then at that date, people will need to have an exemptive solution in place. And 2020-02 will be available, but you won't have to comply with that particular condition of the rollover documentation and disclosure until July.
All right, Carol, you asked for this question to be asked. So Jason, can you shed some light on some of those conversations?
Sorry, Jason.
That's okay. I'm happy to talk about it. Yeah, so we had some very intense conversations. We did submissions through joint trades in terms of written comments requesting an extension. The way we presented the request was for an extension of the entire temporary enforcement policy, as Carol said. Unfortunately, they keyed in on the particular elements that were most problematic and adjusted them as they, to the degree they thought was necessary to address what they heard. So they were hearing some concerns about doing the mailings December 20th as opposed to at the end of the month. They were hearing some concerns about some other things in terms of the annual review cycle having to start at an off time rather than at the beginning of the month. And so they adjusted that by providing an extra 45 days or so through the end of January. And then they heard significant concerns about the ability to produce solutions for the rollover comparison. And so they pushed that out, that extra 6 months to make sure that everybody has time to get their solutions in order. That may or may not prove to be a sufficient time. I think for the majority of the industry, it'll probably be okay. But there will be some stragglers. Some of the smaller firms maybe have to wait a little bit longer to get the attention of their solution providers who don't have the resources to build something internally. They may have some trouble getting ready by that date, but hopefully they recognize that and they're working to get there as quickly as they can. The other thing that I just want to point out is that there has been some confusion about what is eligible for the relief that's available through the end of January. And there have been different views that have been put out on that. So I just want to share our perspective. I'd be very curious to hear what the other panelists think about this. But the way that we read the new enforcement policy is that any recommendation that could be done under 2020-02 is eligible to instead rely on the temporary enforcement policy by complying only with the impartial conduct standards, which is the best interest standard, the reasonable comp standard, and making no misleading statements. So that means that if you have a transaction that you would otherwise do under 8424 or some other exemption, but it's eligible for 2020-02, you can rely on that temporary enforcement policy through the end of January. Some have taken the position that it's just for recommendations that would actually be done under the new exemption. I'm just not sure that there's a logistical, practical way for anyone to know which exemption would have been used in the absence of the enforcement policy. So that's the view that we're taking, and we think that's what the department intended. But I don't know if others will have a different view on that.
I'm looking at it the same way you are, and for the same reasons that you said. I feel like, if you could rely on 2020-02, and then all of a sudden February 1st, oh, I think we're going to do 84-24. I mean, how do you like prove that that's not what you're doing? You know, so I agree. And it's, 5 weeks. I don't see the DOL getting excited about 5 weeks. So, I think I'm, without, giving any legal advice to anybody in particular, because I can't do that, but I'm viewing it the same way Jason is.
Same here, for all the reasons that you both mentioned.
So this is a good point in time to sort of shift over to the compliance and how compliance priorities, I should say, given the timelines, because with the holidays coming up and January 31st around the corner, for I think it was the 25% who said they are just getting started. There's probably a good chunk of work on the horizon. Ed, maybe sort of given your role, given your expertise, I can ask you a few questions on those priorities themselves. If a firm were to start from scratch, what would you say is a priority?
Well, first, make sure you're getting your holiday shopping done during this period, so you don't get in trouble there. No, I think I would be looking at my policies and procedures and starting to update those now. If you haven't started already, most firms should have. And look at the disclosures that are going to be required, have those built out, have a means in place for delivering those disclosures, going back through your conflicts of interest and making sure that they cover all the things that the PTE is going to require, for disclosure around conflicts, mitigation of conflicts, looking at your compensation policy, making sure that you're mitigating any compensation conflicts that are specifically identified in the rule and the preamble, and making sure that you're mitigating those appropriately, and starting to train individuals in terms of what's going to be expected once this begins to take effect, but also just even though that there's been the extension of time with respect to the documentation and disclosure with respect to the rollover recommendations, as been mentioned several times in the discussion today, it's a very heavy lift. So that's something that I would definitely make a priority, and I would start by the enforcement date of in July and start working my way backwards and making sure that I have a solution in place to be able to capture those assessments, to make sure that you have a means by which you're getting the information that you need in order to do those comparisons, making sure that you have the ability to document and disclose, and making sure that you're, again, going back to training, that you're training your sales force or your advisors to be able to use whatever tool you're developing, and making sure that they know what's expected in terms of those assessments.
I would also add, I think, at a high level, this is a principles-based regime, and it was designed intentionally so. One of the things that the department, I think, has seen in its history is that when they have overly rules-based regimes, that they can sometimes find it difficult to effectively go after bad actors because of technicalities that allow those bad actors to escape responsibility. And so by taking a more principles-based approach, they have the ability to avoid that in many cases. But what that does is create some challenges when you're developing policies and procedures, because there aren't quite the same hard and fast rules that you have to follow. But it also does provide, I think, an opportunity to sort of just take a general look at the way that your advisors work with clients, and train them to think not only in terms of what's best for this client, but how would, if this story of this interaction with this client were on the front page of the Wall Street Journal tomorrow, how does that read? If you had to tell your mother about this interaction with this client tomorrow, how would she react? And if you feel good about from those two perspectives, then you're probably okay. And I think it's notable also that the DOL did provide a mechanism by which to correct technical violations in the PTE. So if you're not a bad actor, but you've missed a compliance deadline on a technicality, there are ways to get to rectify that. But if you have mistreated a client, if you have sold someone something that is completely inappropriate for them, only because it lines your pockets, then you're going to have a big problem, and that's exactly what the department is trying to prevent. And that's one area where we are violently in agreement. We want to see bad actors get out of this business. We want to see our clients being taken care of appropriately, and that's the way for this industry to continue to grow and succeed.
You know, Jason, you mentioned the process for self-correction, and it's one of the things that I haven't seen many firms really focusing in on. So I think they want to say, well, what do we need to do in order to be compliant before we start talking about what happens when we're not? But it's important because in order to avail themselves of that, there's very specific requirements. And so firms should really start thinking of, you know, how are we going to monitor for this? How are we going to escalate issues? And then once we escalate issues, what's the decision-making process about how we want to approach this and make sure that we meet all the requirements of the self-correction policy?
Yeah, no, exactly. And I think, you know, in the clients we're talking to, there's only been a couple that have been focused on that, and those are clients that tend to be, you know, kind of first out of the gate in compliance issues. And you know, when you really sit down and start going through those and figuring out how you're going to monitor it, how you know those sort of things, it really does get tricky. And I think that most firms have been struggling with just these basics, you know, the policies and procedures and the disclosure, just because of the timeline. And they've kind of been forced to focus on that. But I think that there's going to be a lot of questions raised, as you said, Ed, once people really start focusing on that aspect.
You know, a question that I've heard raised, and I don't know if I have a good answer to this, is, you know, where's that level where it requires, you know, you to avail yourself of all the requirements of the self-correction piece of this? Like if you're going through and you have, you know, late disclosures in terms of, you know, fiduciary acknowledgement or things like that, where, you know, you're technically not providing things that are all of those sort of footfalls that you catch through your normal day-to-day supervision, right, correction, are those the kind of things that they're looking for to get to notify the DOL every time those happen? Or are those things that they're comfortable with just dealing those as one-offs and making sure that you correct them, and they're really looking for more big ticket items? I just wasn't sure.
Yeah, that's exactly what they're struggling with, the clients who have started thinking about these issues, because it's a little different than kind of the FINRA process, you know, where you know, FINRA is going to come in, you know, every so often, and you know, they're going to, you know, kind of expect to find an error here or there. I think, and Ed, jump in if I'm like misstating that, but you know, this doesn't really have the same kind of feel. And when you try to do your like FINRA sampling, and you try to, you know, move that over to DOL, it's quite a challenge.
And you don't want it to be chilling from the perspective of, we don't want to go looking for problems, because if we do, we're going to have to go through this whole huge endeavor where, you know, with the that model you were just talking about, where, you know, FINRA finds things, they say, okay, it wasn't material, so correct it, move on. You know, can you do that under this, you know, regime? I'm not quite sure.
Clear.
This is a good juncture for us to, I think, transition into what to expect post January 31st and possibly June 30th. Maybe I can open that to the floor, and I know, Jason, you may have some thoughts around what can you member firms expect on the horizon from a regulatory perspective?
In terms of new changes that might be coming?
Yes.
Yeah, so the department has made clear it's on their regulatory agenda. They are working on developing a proposal that would change the definition of who is a fiduciary, might also include some adjustments to 2020-02. And we know that they're also looking closely at PTE 8424 and maybe some other exemptions. Their preference is really to drive as much of the industry to the 2020-02 regime. And, you know, so I think there's a couple of things that we'll see. I think we'll see the definition of fiduciary move, or at least be proposed to move much more closely to the definition that was included in the 2016 rule, which was essentially almost any suggestion of anything remotely resembling investment advice to a plan or participant is likely going to be treated as fiduciary under what they're going to propose. That is, in our opinion, not the right place for that line. There should be a clear sense of what an advisor, a financial professional, can do without crossing the line into fiduciary status. Some prefer not to take on that responsibility. Some have clients whose account values aren't high enough to justify the expense of providing a fiduciary level of service. Some clients just don't want that level of service. They just want somebody who's going to make sure that they understand the concepts and then execute their orders as they give them. And that should be acceptable. So we're hoping that we'll be able to move the department in that direction. In terms of the exemptions themselves, I think that there's a lot of ways that they could potentially go on 2022. A lot of this is speculative, but we know that they've heard from consumer advocacy groups and other interested parties that there should be more constraints on the types of compensation that can be paid under 2022. With it, regardless of any other complaints anyone might have about that exemption, it does provide the broadest level of relief in terms of the scope of compensation that can be paid as compared to other exemptions that have been issued previously. So, we're looking to preserve that as much as possible, and really even extend it to the to 8424 if possible. On 8424, I think we're going to see them try to put the impartial conduct standards in. We may see them try to put the fiduciary acknowledgement in. It'll end up looking very, very similar, I think, to 2020-02, but we think they understand that it does need to be preserved as a separate avenue of exemptive relief, because there is a very significant portion of the insurance industry that conducts business through independent agents who are not owned by or employed directly by the issuers of the products that are being sold. And so there's no way for an insurance company to serve as a co-fiduciary, a financial institution responsible for supervising the entirety of an independent agent's conduct. And so there needs to be a different regime that is tailored to that part of the industry, and that's where 8424 comes in. So we're going to be watching that very closely. We've actually been engaging with the department on that in the hopes of helping them understand how that could work in practice.
Okay, I want to keep our promise to our audience, and we're sort of hitting the last 15-minute mark. Folks, if you have any questions, please submit them for our industry experts here. We have a few questions already in this, as well as that have come in, as well as some questions that were asked ahead of today's session. So our esteemed panelists, please put on your response hats on. We're going to start the lightning round. So with a lot of this expected change that's going to be taking place by way of the Department of Labor, potentially changing things, and given the pending deadlines in January 31st, which is really around the corner after the holiday shopping that Ed mentioned, what do you do? How do you prioritize things come the next couple of months?
I think
it looks like Ed's ready to talk, so
yeah.
No, I think Jason had mentioned this. I think that they're looking to expand things, right? So I wouldn't go. I would go into it assuming that all the things that we talked about with respect to rollover recommendations, needing to do those assessments, having policies and procedures in place, the disclosures that are required. We didn't talk about it, but the retrospective review requirement. I think all of those things I would be preparing to do. And because time's running short now, and they've extended things, I think, as far as they're going to extend them. So I would start working on that stuff right now while waiting to see what else is going to be coming down the pike.
And I would say, with rules in this space coming from all different directions, look for opportunities to leverage what you've done for other regulatory regimes, so that you're not duplicating work. A lot of what you had to do to comply with Reg BI and to comply with the new NAIC model will be able to be leveraged to help facilitate compliance with 2020-02. Not entirely, it doesn't button up every aspect of it, but it can get you a significant way there.
Yeah, I agree with that. That's a good point. The nice thing about 2020-02 as compared with the BIC is you can rely on your Reg BI disclosure or your Form ADV or any other types of documents for like your conflicts disclosure. So the new pieces are the rollover piece and the fiduciary acknowledgement. And I like something that Ed said earlier about kind of, if you haven't gotten started, just kind of get your head around, the training and the making everybody aware of what's going on and understanding the best interest of what has to be done. I think that's a good point too.
Excellent, excellent. Okay, some more pointed questions. And I apologize if I'm kind of rushing through this. I want to make sure we get through a lot. We've got a lot of questions to get through here. A specific question that says, how can we continue to help clients to purchase annuities using PTE 8424 instead of PTE 2020-02?
I think a lot of our insurance companies that we've been talking with are using 8424, at least to begin with. It's a much easier exemption to get started on if you haven't, particularly if you haven't started already, but it's an old exemption. It's made exactly for, selling annuity contracts and selling insurance companies. It dates back to the beginning of ERISA. Everybody kind of knows how it works, and there's not a ton of conditions. So, at this point in time, it's an easier one to comply with. Though, we don't know in the future, they may make it so that it's not, not as friendly as it would seem right now, but at least to get started, it's I think an easier option for insurance companies.
Yeah, and I would add, Carol, it's also an option that's available for folks who may not be sure if they've crossed the fiduciary line or not.
That's a great point. Yep.
Right. One of the challenges with 2020-02 is that you have to declare fiduciary status. And once you declare it, whether you are or not, if you say you are, you are.
Right.
But under 8424, you don't have to say that. So you can still contend, I haven't crossed that line. But just in case somebody finds that I have, I've complied with the requirements of this exemption, so I can still receive my compensation.
Yeah, that's a great point. That's what makes it so attractive.
I'm seeing a bunch of questions that are related, and they're sort of asking the same thing, I believe, which is the PTE 2020-02 disclosure requirement, is this a one-time sort of an annual disclosure, or is it on a per rollover recommendation?
Sorry, I was on mute. For the rollover piece, it's on a rollover by rollover basis because you have to provide a disclosure about why this particular rollover is in the best interest of the investor. So on that piece, it's per transaction, but on the fiduciary acknowledgement and the other disclosure with respect to conflicts and services, I think that can be done at the outset of an arrangement and updated if there is a change that's material that you need to update that. That's my understanding on that piece.
Yeah, I would agree, because what you're thinking of, if you're thinking about kind of exemptions, is what is the particular transaction that I want covered? Is if you ever look at how a prohibited transaction exemption is written, it always starts with covered transactions. And so if you have a transaction that you need to cover, then you need the 2020-02. But if you're talking about like ongoing advice and that's the transaction that you're trying to cover, that might be a little bit different. But I agree, if it's a new rollover, you've got a whole new comparison to make.
Okay. Will a fee comparison be an additional requirement under PTE 2020-02 when comparing plan to an annuity? Specific question. This one's a good one. Any insights?
Yeah, I mean, I think a fee comparison is going to be required. You'll have to know either what the current plan charges or find some alternative if you can't get the actual data, whether it's an estimate or an average or whatever the case may be. And you'll have to compare that to the costs that are associated with the product being recommended in order to be able to satisfy that requirement. So that won't apply until July 1. But at that point, that will be necessary. That's how I read it.
Yeah, I would agree. There's no like carve out for annuities, and it's kind of interesting to think about how do you make that comparison, and it's not just the fees. but you have to kind of look at, maybe for this particular person, they really want a lifetime income solution and their plan doesn't have that yet. That might be a reason why, even if the fees are higher, that the person might be in their best interest. So I think for annuities, focusing on other, aspects of the contract are important.
And I would add there, Carol, that is an area where documentation is going to be so critical
Oh,
for
yeah.
an advisor to be able to say, at the time that I made this recommendation, here is why. I looked at the fees, I looked at the client's needs, their goals, their preferences, and after considering all of that, this was right for them. And then if you don't document that, you put yourself at risk that down the road, either the purchaser, as their memory fades, or their children or some other representative is going to come back in if things don't work out in their favor and argue that it was a bad recommendation.
Yeah.
So document. You can't do it enough.
Agree.
Okay, I'm going to try and squeeze in a couple more questions, maybe 3, hopefully. Maybe this is wishful thinking. Are IRA to IRA transfers considered rollovers that need to be, that will be under the purview of PTE 2020-02?
Yes.
They
At least the
specifically-
department.
Yeah.
Okay.
We've had questions like, what exactly is a rollover? And people say, well, it's a trustee to trustee transfer, but I think the DOL just means any movement. I don't think they're going to be stuck to kind of any kind of technical distinction that someone might try to make.
The analysis will be different, and you'd probably be easier to get the information that you need to do the comparison when you're going IRA to IRA compared to getting plan information. But yeah, it's covered.
I would just say that there are some questions about whether the DOL is exceeding its authority in treating IRA to IRA rollovers as rollovers. But for the time being, the department's view is as Carolyn had said. So I would work off of that until we know something differently.
Excellent. Okay, another goodie. How will the new fiduciary requirements being placed on brokerage accounts differ from the fiduciary standard that's already in place on advisory-based accounts?
I'm not sure if I understand the question. Is it the acknowledgement piece, the fiduciary acknowledgement, or is it kind of in general?
So the question doesn't actually specify, but if I were to interpret the question correctly, I think it's around the rollover. So if a rollover is taking place from a plan to a brokerage account versus a plan to an IRA, or that's already, it's sort of an advisory account, I should say, that automatically has that fiduciary requirement.
Yeah, I think the DOL's position is that the rollover itself is a separate transaction from anything that might go on in the advisory account. And so, even if you've got a level fee, let's say in the advisory account, and so you're not real worried about having as many conflicts there, they view basically it's a but-for test. You would get no money if you didn't roll out of the plan, like whoever the advisor is, whether it's an investment advisor, a broker dealer, or insurance rep. That compensation's not there, and so that's an entirely separate transaction.
Excellent.
I would also just add there, Param, it's important to recognize that the fiduciary status under the Advisors Act for investment advisors is different than the ERISA fiduciary standard. And really, it comes down to the fact that ERISA is a prohibition-based standard that you may not do something unless DOL has an exemption that allows it. Whereas under the SEC rules and the Advisors Act, if there's a conflict and the client is made aware of it and consents to it, you're free to proceed. So it's just a different process that you have to follow.
Excellent. Okay, one more quick question to squeeze in here, and this is directed to Carol and Ed to weigh in on. In cases where there is no advice given, but rather a retiring participant who's already a client of an RIA independently requested a rollover, do they then still also fall under the PTE 2020-02 purview?
Yeah, that's kind of the sneaky piece, and don't know that we all know the answers because it's very much a facts and circumstances test. But in the preambles where the DOL has set forth this interpretation, it does mention that, well, maybe the rollover advice is happening in the middle of an ongoing relationship. And that seemed to me to be a new position. So if you weren't an ERISA advisor, just having that advisor relationship may be enough. Now, I don't know if that's going to survive, if that ever gets tested. There were some when they discussed how this is a regular basis and if you've already got a relationship or if it's the first step, I'm not quite sure logically how you get there, but that there's a risk of that, I would say.
Yeah, and what I've been hearing from people is this question about, what if we don't make recommendations? Are we covered? What if, we're only doing this unsolicited, somebody comes in? And I think that's but I anticipate that the DOL is going to be skeptical if they see a lot of that, and they're going to be looking for recommendations and advice, dressed up as not being so, and that you should really make sure that you have policies and procedures that cover it. You make sure people understand, when they're covered by this and that they're staying within the guidelines, and that you can monitor to see if there's any issues and follow up if you see indications of potential problems. Document.
Yeah, absolutely, on the document.
Okay, thank you to our panelists. Thank you to our webinar attendees today for attending today's session. You've gone 2 minutes over, but I did want to extend the opportunity to continue to engage with our panelists and ourselves. If there's an opportunity where we can show you our rollover analyzer capabilities, we'd love to speak with you soon. Have yourselves a great afternoon and take care.
And Parham, before we wrap up, I just want to add a couple of housekeeping notes here at the end. Just as a reminder to everybody, we will be emailing a link to the recording and the slide deck from today's webinar to all our registrants in the next couple of days. And we also, the four of us will put our heads together and take a look at any questions we didn't get to and try to respond to those by email. And then finally, if any of our attendees today or any of your colleagues want to get more involved in the work that we here at IRA are doing on the standard of conduct space, please feel free to reach out to myself or any of our team members and we'll get you all set up. So once again, thank you to InvestorCOM for sponsoring today's session. Thank you to my fellow panelists and Parham for driving today's session, and I hope everyone has a great afternoon.
Take care. It's a pleasure.